Jonny, markets are crashing, tariffs are back, implied vols through the roof, and investors are running around like headless chickens. What are you thinking?
Well, we're seeing forced unwinds. Confidence in the financial system is being drained away. The economic data that we've got are very firm, but it's just a glance in the rearview mirror. And we've got a Treasury Secretary who seems to have no interest in stabilising the situation.
Hi, welcome to another podcast from Super Macro. My name is Elvis, as you probably know. Opposite me, the heart and soul of Super Macro, Jonny. How are you doing, Jonny?
Yeah, very good, thank you. How are you?
Yeah, well, a bit shell-shocked from the last week and a half or so of trading.
Certainly. It has been interesting.
What do you want to discuss with us today?
Well, I'm not going to talk too much about the economic data. Let's put it this way. Trump had a fantastic economic inheritance when he came into power. Yeah. And it looks like he's doing everything that he can to screw it up. I actually thought that the tariff announcements would lead to some kind of certainty and that businesses and the economy would be able to cope with whatever tariffs were announced. But the two things, first of all, the tariffs were much higher than expected. And secondly, the goalposts keep shifting. So the tariffs were announced. We thought that might be the end of it. And then businesses could adapt and adjust, modify their supply chains, change their prices or whatever. But now we've got retaliation and retaliation to the retaliation. We have no idea where this is going to end.
The unintended consequences of what Trump's actions are is not clear yet. There's bound to be plenty that he won't like and the market won't like as well.
Absolutely. And you're right. And there's stuff that we can't anticipate at the moment. All we can say is that while we've got this very, very strong, very healthy economy, when we look at the labour market, we look at consumer spending, certainly in the final quarter of last year, and most other measures of hard data show a very strong economy, but we're seeing business and consumer confidence collapsing at a fast rate. And that must surely lead businesses to curtail their hiring and capex plans and slow the economy.
Yeah, and as you mentioned in the opening intro, liquidity, a very big basis for everything we do, is starting to dry up in places, which is making the price movements that much more aggressive. Yeah,
so I'll just briefly talk about the labour market, and then we'll talk about what's going on in the financial markets in a bit more detail. So this first chart...
Oh, you've got your slide deck here.
Yeah, so the first chart, the non-farm payroll growth, the most recent payroll growth that we had for March was incredibly strong. And, you know, I break things down into cyclical sectors and non-cyclical sectors. Yeah. And so the cyclical sector, the non-cyclical sectors are government, education and healthcare. That's the red bars in this chart. The cyclical sectors are everything else.
So the higher they are, the better the market is, because that's where the money's flowing to.
I mean, you can just look at these red bars. They're fairly, they print at a fairly constant amount each month. The blue bars, the cyclical stuff, that's more variable. But what we've seen is that we've just had the strongest print, the biggest increase in cyclical sector employment, the third biggest increase that we've seen for at least 2 years. And not only that, if you look at average non-farm payroll growth over the last 6 months, it's something like 180,000 a month compared with 150,000 a month over the past year. So payroll growth was actually picking up.
Are you trying to highlight what is the strong economy that Trump inherited? I assume that's what you're trying to do here.
Yes, I think the thing is the data, the hard data that we have so far don't reflect the collapse in business confidence. The hiring still proceeded. The consumption data that we've had have been affected by the weather and the wildfires in Los Angeles and, you know, various other things. Have rushed to buy ahead of the tariffs just during the final quarter of last year. So the data have been thrown about a little bit by one-off factors, but in general, they've been very, very firm. But I just can't see it holding up the way things are.
What about government cutbacks? How have they featured on this in this market?
Well, this, you know, it is for everything that Musk says and the Doge cutbacks, federal hiring, there's a federal hiring freeze. And in the last payroll print, I think it was 216,000 or something, 218,000 in total. I think there was, the government shed something like 4,000 jobs in that. So, really made no difference. And then state and local hiring was something like 20-something thousand jobs. So the Doge cutbacks, we're just not seeing that in the payroll data. Now, certainly, I think there's something like 70 or 80,000 government workers have accepted the voluntary severance, but it's been deferred. It's deferred. They can work out that period. They don't count. They're
later
still
in the year.
They're still counted as on the payrolls up until I think October. So that's in October I think we'll see a decline in payroll growth. Sharp decline.
I can see the second chart is looking at US consumption. What do you want to say there?
Well, this was just, when I first started thinking about tariffs, I thought, well, maybe the economy has enough momentum to be able to withstand an increase in the tariff rate. Because if you look at the consumption basket, 30% of it is goods, 70% is services, and of those 30% goods, only 20% are imported. So about 6% of what Americans consume is imported goods. So putting a tariff on that won't raise the price level by that much. It won't have a massive impact on consumption. The economy should be able to cope. And what it would do, it would go some way to narrowing the budget deficit. I mean, the private sector benefited tremendously from government largesse after the financial crisis and after the pandemic. So, now we've got the government that's got a very stretched balance sheet. The private sector's in very good shape. Now things have to reverse. We have to get the government's balance sheet back under control. We've got to get the deficit back down.
Yeah.
So these tariffs would have brought in perhaps 300 or 400 billion of tax revenue. And why not? Why not impose a tax on consumption of imported goods? Maybe that could work. But I think the way it's been done, the way the White House has gone about it, and these random announcements, unexpected announcements, and this retaliation, and so on, is just really.
It's like he's in a school. He's like in a school playground.
Yeah, it is. It's like he's the bully in the school playground, and he's determined to just bash everyone and show who's boss.
The thing is that this is the what I've spoken to you about before, is that I don't necessarily disagree with what he's doing for the US. What I disagree with is the speed of change. You can't do things in a couple of weeks. This should be taking months, maybe years of negotiation to get it right.
Yeah, or just something fairly simple, fairly straightforward, one-off, and it's done, like a 10% across-the-board tariff. Put it in place from day one. Allow businesses to come to terms with it and adjust their supply chains or whatever they want to do. I think the market would be able to cope with it, and I think businesses would too. It wouldn't have such a detrimental impact on the economy. Okay,
so importantly for most people listening, what do you think about markets, specifically the S&P?
Well, as you know, I've had a negative view on the S&P. I thought it was overvalued. I thought it was overvalued for quite some time.
Price for perfection.
Beyond perfection. And sure, I managed to make a little bit of money by buying some put spreads early in the year when volatility was a lot less expensive. But now, of course, implied volatility is through the roof, as you rightly said. And I don't think the S&P is cheap yet. We can see on this chart the S&P has fallen a long way. It's just gone straight down. It's nosedived.
Well, the market's looking south, not north now. So, the extremes will probably be approached on the downside as well as the upside. The upside was.
Yeah, but I would say we're nowhere near an extreme. And if you look at this chart, what I've done is I've done the scales so that when the blue line on the left axis is the 12-month trailing earnings per share. The red line is the S&P index itself on the right axis. Now, when these two lines overlap, it's when the S&P is on a P ratio of 17 times trailing 12-month earnings.
Right.
So you can look through history, and if you look at that chart, you can see that there are times when the S&P is cheap, when it's trading below 17 times PE ratio based on historic earnings, and when it's very, very rich. And where we were at the end of last year was just insanely rich. And even now, we're on about a 20 times PE ratio versus 12-month trailing earnings.
Right. It's amazing, isn't it, how long the market can go and ignore the warning signs and get even more and more expensive. And then suddenly there is something that comes out that starts to look at the warning signs and then craps very quickly.
Well, I think, it's no good just standing in the way of it and saying, look, I can tell this market is massively overvalued, I'm going to go short, because you get carried out. You can't do that. And all these analysts, the analysts that were fired for saying the market was overvalued, as they have done for a couple of years, but even though they were saying it was massively overvalued, the market carried on going up 25% a year for 2 years running. So, that it's no good as a trader just saying, right, I'm just going to be short because it's massively overvalued. But now that the things have turned, it's worth looking at valuations and saying, does this represent fundamental good value to buy at the current level? And I would say, no, I don't think so. I think it could go a lot further. And one of the justifications for the market being on such a high multiple was that earnings growth was so strong. We did have pretty strong earnings growth.
Yes, and that's been revised down a little bit, isn't it?
Well, yes. We had earnings per share growth of in the prior 2 years of a total of 20%. But the PE ratio expanded by 30%, which is why the market went up by 50%. Well, now we don't have the same sort of earnings per share growth expectations. And in fact, those expectations are coming under more and more pressure as things get rougher and rougher.
So it's 2 points to the market, isn't it? Not only that the earnings per share is predicted to be lower or lower growth than we had before at the end of last year, what you're going to pay for those earnings, you want to pay less for them in terms of your multiple.
Yeah, if there is any growth at all.
Yeah, okay, fair enough.
Okay, so that's the equities, but we're also seeing...
the bond market, yeah.
Well, we're seeing it's not just the bond market, it's currencies, it's China, it's a lot of things. And if we look at this next chart, this is...
Quite a relevant chart and quite a relevant topic for today, especially this morning's action.
Yes, yeah, I think this is relevant. The red line on the left axis is China's total holdings of treasuries in billions. Now, the important thing here is that there were a much bigger share of the market back in 2014, 2015. Not only did they hold more treasuries in absolute terms, but there were less treasuries outstanding at the time. So, although China has continued to run a trade surplus with the US, they haven't...
Where's the money going then?
It hasn't been... Well, it's probably... It seems to have been going into gold lately.
Right.
But I think, you can see the red line. China is running down its holdings of treasuries, and they're not necessarily notes and bonds. A lot of this is bills. It's another way of holding dollars and earning some kind of interest. But now I think they're saying, well, we don't really want to hold dollars anymore. We're gonna put it into gold. We're going to put it into maybe euros or maybe into other currencies. And for the Chinese currency on the right axis, that is declining.
It's inverted, obviously.
It's inverted. So now, there's more and more yuan to the dollar. And I think, this latest development in the trade war where China today has announced...
We double our tariffs, you double your tariffs. Yeah.
So the US has put the tariff rate on China up to 104%. China's retaliated with 84% now. I'm not sure where this ends up, but one of the things that China can do to punish the US would be to let their currency slide a bit.
Yeah. And dump some treasuries.
Maybe dump some treasuries. Maybe just actually sell them outright. And I think that's what's concerning the market today.
So China's really only got, if this carries on, what are the choices for China here? I suppose they could... devalue the currency, or
let's put it in perspective. China's exports to the US are something like, speaking from memory here, 10 to 20% of their total exports. And exports, net exports, is not the whole economy in China. It was a big part. It's a declining share of their economy.
Yeah, but consumption, local consumption needs to be improved. That's
Absolutely. So
the export model only works for so long.
So the government's balance sheet is not overburdened at the moment.
Not at all. No.
Exactly. Something like 40% debt to GDP.
Yeah,
something
but local
like
authorities have got
local authorities have got more. Yes. So the government can do its bit to support the consumer, do more to help with the housing market, and get consumption to grow.
Do you see maybe like a 2011 stimulus that they had, that monster-sized thing they put up is it 2011 from memory?
Yeah.
Do you think maybe one of those is coming? Or
I don't think it needs to be that big. I don't think they need to. I think, I don't know what they're going to do. I really have no idea. But I think the important thing is nobody in the market knows either.
Right.
And at the moment, people are kind of running around like headless chickens. Now, the other thing that I would say that is important to note here,
yes,
is let's come on to this chart here. I don't think the Fed or other central banks can really step in. Well, they can do what they like, but stepping in with by easing policy to support the markets may backfire, because inflation expectations. Now, this was last month, the University of Michigan survey, the long-term consumer inflation expectations. That's that blue line. It's just going.
It's going to exceed the red line. We took that survey today, I assume.
No. This is from the this is the March. The last survey was in March for the University of Michigan Consumer Confidence Survey. The red line is the actual average increase in the consumer price index over the last 5 years, which has been 4.3% a year. Now, it's that high because we had that burst of inflation in 2022. It got up to 9%, but then the average over these 5 years now is something like 4.3% per year over 5 years. So now you could say, well, consumer inflation expectations have become much less well anchored. So for Powell now to say, okay, well, we're going to cut rates because we're worried about the economic impact of these tariffs, which are going to put prices up. Powell faces the challenge that he's going to further de-anchor inflation expectations, and he's easing into a period of rising prices, which goes against central bank policy. And the danger is that the long end of the Treasury yield becomes even more unanchored than it is currently.
What about if unemployment starts to pick up and gets close to 4.5%, 4.75%? That's probably the trigger for him. He's got, because they've got a dual mandate, as you'll explain. Yeah,
but that's quite some way in the future. Let's put it this way. I think even with what's been announced and with business confidence sinking, with the tariffs that are now in place as of now, I don't think that's going to be, we're going to see the true impact of these measures in the hard data for quite a few months. And I don't think you're going to see, I don't think you're just suddenly going to see companies laying off people en masse, because I think consumption will trundle along okay for the next few months. It'll take time before things start to really fall apart.
So are you trying to say that the Fed will unfortunately be behind the curve in this particular one? They'll have to see the evidence start heading south before they can activate themselves.
Yeah, because there is a danger that if they do too much, the market says, well, okay, you're just behaving like an emerging market economy.
And your borrowing
cutting
costs
rates,
go up.
You know, the Treasury is borrowing more in the front end of the curve. The Fed is accommodating that by lowering rates, and inflation is still way above target and set to head higher as a result of these impacts, these tariffs. And yet the Fed is cutting rates. I mean, it is not going to be a good look.
Yeah.
I think what we are going to see, almost without a doubt, is the red line is nominal GDP growth advanced by a quarter. So we don't have Q1 nominal GDP growth, but we do have the S&P operating margin, the blue line on the left axis. So nominal GDP growth year on year in Q1 is probably going to be, probably going to be closer to 4% now.
Is this, just to stop you there, the nominal GDP growth, is that affected by the people bringing forward purchases and stockpiling in front of the tariffs? Is that?
Yeah, that has an interesting effect. We saw a lot of that in Q4. We also saw quite a bit in Q1.
And the gold effect as well, delivery
well,
of gold.
Well, let's take that out of the equation. But the surge in imports that we've had have knocked Q1 GDP, or the estimate of Q1 GDP anyway. But I think the imports go somewhere. They don't just disappear. They end up as an inventory build, or they end up in higher consumption. They don't just disappear. So the Atlanta Fed GDP now model just has really the impact of the increase in imports at the moment, showing a negative GDP print for Q1.
Right.
I actually think it'll still be positive. And then this surge in net imports will kind of unwind in Q2, so they'll have a positive impact on GDP.
Right.
So that's what I mean. All the hard data that we're seeing now is very backward looking. It's all messed up. We're not going to have a true picture of the underlying strength of the economy for quite some time. But what I can be fairly sure of is that these tariffs will compress corporate margins. So, the companies in the S&P are not going to be making operating margins north of in the mid-teens over the next year. They're going to have to absorb some of this tariff increase in their margins. And not only that, if consumption slows down, those margins will come under even further pressure. I mean, you've only got to look at what happened during previous recessions. The margins come under a lot of pressure. So, I think, it gets back to my first chart. I don't think it's the right time to pile into equities. And I think if we look at implied volatility, sure, it's picked up a long way.
For obvious reasons.
But I wouldn't say it's at extreme levels. It's
amazing. We've had a few 5% days. We've had like 6 or 7% up in like low to high moves or high to low moves. And realized volatility captures close to close. The implied volatility is, it's not even as high yet as it got in June of 2022 when the market was selling off. And of course, in the pandemic, it just went up to 80 or so. So we're not at what I would call extreme levels. And it's strange, really, because, the COVID and over 2020 was all the unknowns. And I feel as though exactly where we are now, it's unknown what's going to really happen. How is it going to properly pan out?
Yeah, I think that is the problem. We just can't get a handle on what the true effective tariff rate will be when the dust settles. And I think that's why I think it's dangerous now to start trying to pick a level where you want to get long of equities or put any sort of trades on at the moment. Things are just becoming completely dislocated, unanchored, and times like this, I think it really is best to just say, okay, either I'm going to take very, very small punts, really small
punt, wider stops, rather than
wide stops, rather than any big macro fundamental position. As macro traders, we like to say, well, I can see this happening or that happening, or the central bank's going to do this or that over the next few months. But right now, honestly, I think anybody that claims they've got any sort of clue for how the economy is going to perform or how the central banks are going to react is just deluding themselves.
Normally at the end of these podcasts, we talk about what you're going to put on. Now, you've made it very clear you haven't got a compelling trade in your mind at the moment, but what are you looking at? Are you looking at any specific levels in the S&P that you might want to play as a long side, or are you selling into rallies if you had to do something, or bond markets, you still want to be short the Treasury? What are you thinking?
Well, I would say for the S&P 500, I think, it could get down into the low 4,000s.
Yeah.
So that's where I think maybe I might be interested in buying it.
That would go along with the trading PE of around about 17 if it got to there. Is that what you're saying?
Yeah.
Okay.
And then for the rates markets, a few weeks ago, I was talking about the spread between 10-year treasuries and 10-year bonds, which was north of 200, dropped all the way down to 130, 140 with the German promise of the massive fiscal stimulus. And I thought that spread could drop down, even further below 100 basis points. But what is going on now is that maybe a lot of other people had the same idea and are now being forced to unwind that trade.
Right.
So treasury yields are going much higher, and bonds are not following them at the same pace. So
might be recipient of some of the cash that's coming out of treasuries going into bonds. People feel safer lending money to the ECB or the Europe than the US.
Yeah, quite possibly. That is, the bond is now the safe haven, and treasuries no longer are. And this has been a concern of mine since the start of this year, with the way that the administration has been behaving, and also to some extent the Fed. I just think treasuries are very vulnerable. So I don't have a target in mind for the 10-year. It could easily go to 5% during an economic slowdown. Why not? Until there is some order, until we get some sense from the White House. And it's especially worrying for me to see someone like Besant, the Treasury Secretary, who clearly doesn't stand up to Trump at all, just says, his policies are good, this is pain that we need to go through, everything's going to be okay in the end. It's completely different. In previous financial crises, and just if you think about the financial crisis, the great financial crisis with Tim Geithner and the policymakers at the time.
Paulson, wasn't it? Was
Hank Paulson as well, and prior to Geithner, and the advisors, the Council of Economic Advisors. You had some kind of confidence that they would deliver something to stabilize the situation. Right now, the chairman of the Council of Economic Advisors was the architect of these dramatic tariff increases, and in the same paper was talking about effectively haircutting treasuries.
Yeah, that's frightening
Absolutely frightening thought. He later downplayed that, said, it was just a suggestion and didn't mean for it to be taken seriously, but happened to be in the same paper.
What you say or what you wish for.
Yeah. So we've got a very, very different, there's just no adults in the room now. There's nobody to kind of talk sense and stabilise the markets.
Jonny,
that's what concerns me.
I'd like you to tell people where they can read your more detailed thoughts on macroeconomics and how they can get hold of you, etc.
So certainly, I write Super Macro. It's a daily note. There are traders at most of the large hedge funds and investment banks that read it. It's delivered daily. And
you've now made it available to everybody else to read.
Everybody can read it. You can take a trial subscription, and if you like it, you can subscribe.
Perfect. Thank you very much indeed, Jonny.
Thank you, Elvis.